problem as far as deficit is concerned. Because of deficits, we don't have the funding to address other problems that will come up on the horizon. That is government financial guarantees, i.e. the FDIC guarantee to depositors. And I'm talking about Freddie and Fannie, and now student loans are becoming an issue. So basically, we don't have the money in the pot to address the financial guarantees. What we're doing with the banking sector is we have 900 banks on the endangered species list, and the FDIC dutifully, by law, since they're observing the law, instead of closing all the ones that they've identified, they choose the two smallest banks in the country a week. And they take Christmas off. So they do, for 50 weeks, they close 2 banks. They close 100 a year, and they're constantly looking for the first bank, First State Bank of Waxahachie or something. I mean, they're looking for a bank with less than $100 million worth of deposits so that they wouldn't have to come up with much in the way of deposit insurance coverage. The reason is that they're out of gas. They don't have any more. That's it. And they're on a budget that has been imposed upon them because they're insolvent. They had a $500 billion line of credit with the Treasury, and the Dodd-Frank bill eliminated it, put a cap on it as to where they are right now. So there's no money in the till. Then the question is, what about the Fannies and the Freddies? Now, we've actually had a lawsuit come about 3 weeks ago where Fannie and Freddie's going back after the origination banks who originated it. However, from my perspective, these are two government entities fighting it out, and if one pays, the other government entity, so net to the private sector is zero. No, actually net to us. If there's a bill, we pay. So financial guarantees are getting us nowhere, and there's no money in the pot for that. And those issues are pregnant, very much so. All right, then on top of that, we have, first time in history, an impaired central bank. The Fed is, quote, impaired. Let me use that term, and let me define what I mean by impaired. They did what I call QE0, which was 2 years ago, when all the banks got run. When I say the banks got run, in the general sense of investment banks, commercial banks, U.S. and abroad, whether or not they were members of the Federal Reserve System, hedge funds located any and everywhere, they all were run in the sense that they were financed by short-term overnight lending in the financial market, and the short-term provider of funds said, I want my money back, and they were forced to sell assets, which is a financial meltdown, which is what Europe's about to go through. And the Fed, and Bernanke in particular, said, look, I study the Depression, and that's what my PhD is about, and he reckons that the Great Depression in the 30s came about because the Fed did not lend. The money supply declined by 30%, the number of banks declined by 30%, and even though we had a central bank that was mandated to do this, they didn't do it. And he said, by God, I'm not going to do that if I'm chairman of the Fed. So he loaned to any and everyone and any amount they wanted on any collateral. And it was above and beyond the law, but there was an escape clause in the law that allowed him to do it in unusual and exigent circumstances. Well, I presume Lehman Brothers weekend, which, by the way, was, what, 4 years ago this week, I think. I think it's 4 years ago this week. So basically, he said, I'm not going to do this, so he loaned to any and everyone on any kind of collateral, whether they were U.S. or foreign, whether they were a commercial bank, an insurance company, it didn't matter, he was lending to everyone. By the way, at some point, and the point came last summer, when they had to disclose finally who they loaned to. Up to that point, they only disclosed the aggregate amounts on the balance sheet, and they just called it a loan facility. Last summer, when things calmed down and when no one was looking and everyone was on vacation, they came out with a specific identity of who they loaned to, and I think the number one at the trough was Goldman Sachs for $600 billion, despite their, of course, saying how wonderful we are and how smart we are and all that kind of stuff. That's the first impairment. That was the Fed. By the way, they didn't lose any money on that one because the economy did come back. But the point is, I don't know if they're going to be able to go do that again if we have another financial meltdown. They are definitely impaired. The reason is we're having political backlash as a result of it. So that's number one. Number two, they bought over $1 trillion of mortgages and private securities, which they've never done before. The only thing the law mandates that they only buy government securities, not private securities. And then number three, and the over top one, was the QE2. QE2 started about 11 months ago because the economy was wobbling, and their solution was the ultimate monetary policy, and that is QE2 was a $600 billion purchase of treasuries over 9 months. And it's an amount equal to about 15 to 20 years of normal expansion of the Fed balance sheet, and they did it all in 9 months. Now, if that's not going to be a, you know, if that doesn't wake the economy out of its funk, what else can you do? And it turns out it didn't do a thing to the economy. It did for a couple of months, about 3 months, and I have a pretty good tape, in fact, wonderful tape on my website of videos of Lacey Hunt, who on the issue of why did QE2 not work. The reason is the money went out there, but the commercial banks are not lending. And where it went was to the hedge funds who took it abroad, and it stimulated foreign economies. And the foreign economies ended up having a lot of inflation. And now we're buying products produced abroad, and we're paying an import inflation rate of, the new number came out today, 13% is the inflation rate on imports, 13%. So basically they created inflation abroad, stimulated foreign economies, and essentially did nothing to our economy. In fact, what we did was we went backwards because there were no new jobs, no higher wages, but prices rose, so that real income declined. So basically we're backwards. So I say we're going to impaired central bank. They're not going to do it again. Now they're meeting again on the 21st and 22nd of this month, and they're going to come out yet with something else, and everyone is, it's not going to be another QE. They've already have mud on their face on that one. You know, it's bloody. What they're going to do is fiddle around with interest rates, but interest rates are essentially at the ceiling, the floor. They're at 0. So they might take it from 1 to a half. So what is that going to do? That's not going to do much. Now they're going to some extent, that's expansion of money, because to get interest rates that low, they got to buy. And so they got to print and buy. So they're not going to advertise it as a quantitative approach, but an interest rate adjustment, but it requires money. But basically the Fed has no, they're tapped out. They've made the money as cheap as it can go. It can't go any, unless they run interest rates negative, which is conceivable, but so basically the Fed is impaired. Now the Fed is impaired not only in terms of they've gone as far as they can go, the market rates can't get any lower, but on top of that, what starts to happen is when the Fed buys mortgages, they now have an asset on their balance sheet that has credit risk, just like the commercial banks. And it's not yet an issue with us, but it's not far off the horizon, but it is an issue in Europe because the ECB, in a similar type situation where the debt meltdown was not mortgages but sovereigns, have been lending to the banks collateralized by sovereigns. And of course, the banks are using the Greek debt to borrow against the ECB. So when the music stops with the meltdown of Greece, which is, I got to say, imminent, unless somehow Merkel somehow is able to get their parliament to agree to this, which doesn't appear to be at all even possible. So when the Greek bonds go down and the whatever else is in line, but I think the run hit Italy and Spain recently, I think Italy in particular last week or two. So basically on the balance sheet is they have loans to commercial banks collateralized by the sovereigns, and the sovereigns are worthless. What then happens is it becomes an event when the default occurs, and that's why they're trying to avoid an actual default, because an accounting event. When the default actually happens, then they have to recognize the loss, and then the central bank is insolvent. You understand that? Their assets are getting crammed down, and they financed it with euro. So what is the market doing? Well, they're finally running to the dollar. Even though our situation is dire, it's not as dire as Europe's situation. So finally this week, after running to other currencies and gold and other places, obviously the first place was Switzerland, now they're finally coming here, but we're going to actually look at a situation. Now I'll tell you what happens if the ECB has to recognize their insolvency, and that's an immediate capital call on all the member nations, and which means a tax bill, and they can't afford the tax bill. So their implosion is imploding on each other. the sovereigns go down, the banks go down, it takes the central bank down. So watch what happens there. In fact, our politicians and market is watching it as a demonstration of what can happen here. And actually, it's good news for us in the sense that we're getting a demonstration project of when the unthinkable happens. So we finally see what it's like, and I think it's making a positive effect on the willingness of the politicians to step up to the plate. All right, so one other last thing. Given the low interest rate, we have one other piece of collateral damage in the economy, and that is interest rates are so low. What that means to a lot of you and a lot of individuals is investment income is essentially negligible. Retirement incomes based on debt go to zero, essentially go to zero. Trying to live on treasuries or trying to live on fixed income. So then you have another segment of the population that's grossly weakened on top of everything else. By the way, in that pot of who's grossly weakened from the cheap investment income are the financial institutions. The University of Texas Endowment Fund holds a lot of fixed income. The pension funds hold a lot of fixed income. And as each of these debt instruments mature, they go back to the market, get marked down to a much lower rate.